We can beam a 4K video across the globe in milliseconds, but buying a piece of a public company still takes an entire business day. It involves a structural delay called T+1 settlement. This friction is the result of a closed system. Investors are forced through a maze of brokers, banks, and legacy SWIFT payment networks. These networks act as toll booths, leaving investors in emerging economies effectively locked out of US wealth generation. Underneath the sleek digital interfaces of our trading apps, the legal architecture governing equity still relies on antiquated concepts of paper ownership. Every transaction ultimately traces back to the documented movement of these physical certificates. The global equity market holds roughly $147 trillion in wealth, yet it operates on the financial equivalent of dial-up infrastructure. But the institutions running this machinery are aware of its limits. The very entities that process nearly every US stock trade are actively building the architecture to move trillions of dollars in equities onto blockchains. Asset managers like BlackRock view tokenized stocks as the inevitable future of market efficiency. CEO Larry Fink has projected that every stock and bond will eventually be tokenized, replacing the friction of the current system with digital speed. At the center of this shift is the Depository Trust Clearing Corporation, or DTCC. This central hub safeguards nearly $100 trillion in US securities. They have received regulatory clearance to begin creating blockchain-based digital versions of the highly liquid assets they hold in custody. Wall Street is transitioning the record of ownership from private bank ledgers to a shared, transparent protocol. The engineering challenge is complex. How do you take a regulated share of a company like Apple and convert it into a programmable piece of code? This flowchart illustrates the historical blueprint they're using, the American Depository Receipt. In the traditional ADR system, a foreign stock is locked in a custodian bank, and a domestic receipt representing that stock is issued for trading in the US. This diagram shows how tokenization maps onto that model. A custodian secures the physical stock, and a platform mints a digital token to represent it. This creates digital twins, fully backed by shares, and synthetic wrappers, which only track price movement without true ownership. In the digital twin model, the token is simply a highly efficient technological container for an old-world legal contract. By placing that container on a blockchain ledger, trades bypass legacy intermediaries. The corresponding banking taxes and multi-day settlement delays are stripped away. Financial markets are no longer restricted to the opening and closing bells in New York. The system becomes a continuous 24/7 market where trades settle atomically, meaning the asset and the payment swap instantly in the same second. Because these tokens are just code, they can be infinitely divided. An investor in an emerging market can completely bypass legacy capital controls to purchase a fractional cent of a US equity. Because the blockchain records ownership as a live digital entry, the token itself can be programmed to act as a reserve asset. By locking these digital shares into a smart contract, they function as automated collateral, allowing investors to borrow against their holdings in decentralized lending pools without a manual review process. Equities evolve from static assets in a domestic database into a fluid, borderless currency. But a stock is not a stablecoin. A dollar is just a dollar. But an equity carries heavy legal baggage, things like mandatory dividend payouts and shareholder voting rights. This creates a structural glitch. If you deposit your tokenized shares into an automated market maker, a smart contract designed to provide liquidity, the contract itself technically takes ownership of the tokens. When the company issues a dividend or a proxy vote, they only see the anonymous smart contract, leaving the true owner disconnected from their legal rights. Blockchains use permissionless and pseudonymous architectures, while capital markets rely on strict identity-based know-your-customer regulations. Engineering digital tokens to move value is a solved problem. Translating complex, jurisdiction-bound legal rights into self-executing code is a logistical nightmare. And that friction is leading to a regulatory collision. US regulators are currently preparing to approve two entirely different architectural tracks for trading tokenized stocks at the exact same time. The first is the Wall Street Rail, championed by the DTCC. It preserves traditional shareholder rights and clears trades on a standard regulated delay. The second is the crypto-native rail, an open ecosystem where third parties can issue synthetic wrappers that trade continuously, but may not confer actual ownership. This parallel structure is actively being drafted by leadership within the Securities and Exchange Commission under a framework called Project Crypto, which uses innovation exemptions to permit these parallel markets. This creates a scenario where the exact same company is traded across two incompatible markets with different rules and settlement times. If the market liquidity splits across these two different rails, the unified price discovery that anchors global finance will shatter. Tokenization will incorporate trillions in global capital, but if regulators cannot bridge these two competing rails, they will accidentally fracture the very market they are trying to fix.